And I would bet that that would probably coincide with gold one being back to and through its highs, 2,800, but silver also back up to its highs, 35. At that point in time, silver's still cheap to gold. I mean, like you said, gold's way over its 2011 high and so forth. Silver's not above its dual highs at 50. I think it's the next move that's likely to blow that stuff out. And I don't think 50 is a target, by the way. If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just it's a paper target. You know, everybody's looking at it, but you'll blow it out. You'll go well up in between there and 100 or something. I've got some reasons to think the mid-60s before you even stop for a pause.
Gold has broken new ground, surging past $2,805 per ounce to establish a fresh all-time high. This remarkable performance comes as major central banks adopt a more accommodative monetary policy stance. The Federal Reserve's decision to maintain current rates while remaining non-committal about future moves has reinforced market expectations of 2 potential rate cuts this year. Meanwhile, silver has been making steady gains. It is currently trading at $31.60 per troy ounce, marking a modest 0.18% increase from its previous price of $31.55. Financial analyst MichaelOliver argues that silver is significantly undervalued compared to gold, as it has not yet reclaimed its 2011 peak of $50 per ounce. He views the $50 mark as a paper target that could be surpassed, and projects silver could reach $100 with possible consolidation around the mid-60s. This outlook is partially supported by FX Empire's forecast, which envisions silver reaching $50 per ounce by 2025. However, the path to $100 would depend on various factors, including supply-demand dynamics, inflation rates, and the gold-to-silver ratio. Oliver's analysis of the silver-gold spread is noteworthy. He believes a slight rise in silver prices could significantly lead to a significant breakout as gold surpasses $2,800. This suggests both metals may experience upward momentum soon. According to Wallet Investors' analysis, gold prices are projected to fluctuate between $2,733.64 and $2,921.55 through 2024 and 2025. With an anticipated level of $2,812.27 by December 2025, supporting the bullish outlook. Market observers suggest that if prices maintain levels above $2,800 through next Friday, a push toward $3,000 in February appears feasible. Before we begin the video, please subscribe to our channel, click the bell icon for timely updates, and share it with friends, family, or anyone who may find this helpful information.
I think gold and silver have begun to emerge from the recent pullback. Now, silver got whacked today, but silver, we call silver the little dog on a leash. And the mama, the holding the leash, is gold. So anytime you think you see silver jumping off a cliff, it's got a leash attached to it. And if gold isn't jumping off a cliff, then silver's not, okay? Keep that in mind. And next thing you know, silver turns around to $1 off the low, that kind of thing. I think we're turning back up after the congestion. Gold got a couple of days ago, within $1.50 of its all-time high. And somebody said, I think I'll sell it and risk a nickel to make a dime. Okay, they did. But I think the major trend there remains positive. It remains no longer congestive like it was all during mid-2020 through early 2024, where gold was in this up-down range. In March of last year, we declared that process of corrective process in silver in the miners and sideways process in gold was over. We're going up. Okay. At that point, gold was just above 2,000. At a place it had been 3 or 4 times before in the prior couple of years, so no big deal, but it was to us. And sure enough, you've reached 2,800 recently. Silver at that point was $25, headed toward 26. Didn't mean much on a price chart, but within 9 months it reached 35. Right now we're either side of 31 for the last couple of weeks. I think they're continuing up. I think the main thing to propel them at this point is fracturing of the stock market. When the money flows out of that beast, as it will, it always goes somewhere else, and that place has almost always been gold if you go back through history. And I think that's likely to happen this time. So when you see the downticks in the stock market, take that as a positive background feature for gold. And when you break the stock market, I think that's when you will start to see the verticality, which we've already seen some pretty good stuff. If you stand back and look at it, ignore the zigzags that always occur. Gold, for example, last year, close of 23 to close of 24, was up more than the S&P. Silver matched basically the S&P. So, nobody cheered that. It wasn't on the major financial channels. It was all stock market. So they've ignored that reality. And I think you'll start to see a further separation where gold continues up and its related markets, and the other paper assets start to bleed. And when they bleed, that money goes somewhere. Now, as far as silver versus gold, it's dirt cheap off the page. We know that, historically speaking. Now, it's either fundamentally lost any rationale for being, which we know isn't true, or it's an error. Silver's just priced too low. These things happen in markets. Markets get priced too high and they pay the dues. Markets get priced too low for so long and they go up and you hardly need an excuse. It's just that they were underpriced for too long. And I think silver's in that category. Technically, we can measure the spread relation between silver and gold. And I've got some numbers that we're monitoring that wouldn't take much on the upside over the next few weeks even, where silver gains a bit to gold, and it will break out on these technical metrics of measuring the relationship between the two. And I would bet that would probably coincide with gold one being back to and through its highs, 2,800, but silver also back up to its highs, 35. At that point in time, silver's still cheap to gold. I mean, like you said, gold's way over its 2011 high and so forth. Silver's not above its dual highs at 50. I think it's the next move that's likely to blow that stuff out. And I don't think 50 is the target, by the way. If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just a paper target. You know, everybody's looking at it, but you'll blow it out. You'll go well up in between there and 100 or something. You know, I've got some reasons to think the mid-60s before you even stop for a pause. But the key right now is that what happens in this current situation. Break that stock market. Break the Sensex, break the Nikkei, and you'll have central banks go berserk, and we know what wins when they go berserk.
According to analyst MichaelOliver's research, the relationship between gold prices and mining stocks has historically followed predictable patterns. The XAU Gold Miners Index typically maintained a value between 25 to 38% of gold's price, rarely falling below 17 to 18%. This long-standing correlation, however, faced a significant test during the 2008 gold bear market, when mining stocks experienced a dramatic decline that bottomed out in December 2015. Current market dynamics show intriguing parallels and divergences from historical trends. Gold has gained 12.79%, and the GDX Gold Miners ETF rose 9.42%, tracking the S&P 500's 15.29% increase. However, gold's significance lies in breaking out of a four-year trading range, 2020 and 2023, to reach new all-time highs. Despite this technical achievement, mainstream financial media remains skeptical, focusing more on potential downsides than on the milestone. The 2008 financial crisis is a crucial case study in understanding market behavior under stress. During this tumultuous time, the gold and the miners index departed from their bullish trend, experiencing significant declines. The crisis highlighted a notable pattern where investors, facing market pressure, chose to liquidate their gold positions alongside other assets, challenging the metal's traditional role as a haven during market turbulence. Let's get back to the interview.
I'm emphasizing right now not gold and silver, but silver over gold, but also the miners. The miners are dirt cheap compared to gold. Historically speaking, go back 20, 30 years, you can look at the relationship between them. And also the gold miners as a subsector of the stock market are off the page cheap compared to the S&P. But that sort of hides the truth. The top chart shows the XAU index, which is the Philadelphia Gold and Silver Miners Index. It's been around a long time, since the 1980s, so this is why we use it. It's got a lot of history. And when you look at that spread chart versus gold, you'll see that the spread relationship between XAU and gold, and what we do to measure that is we measure the price of XAU divided into gold expressed as a percent. And so back in the 1980s through 2008 or so, XAU index was trading at 25, 30%, even got up to 38% of the price of gold. XAU versus 1 ounce of gold. And the lows were around 17, 18%. Meaning whenever you get a dip and the price of XAU dropped to about 18%, it would find support. And so in that top chart, you'll see there was this range at a high level. But in 2008-9, just prior to the onset of the gold bear market, the spread broke, where the miners started to break in relation to gold. And their performance collapsed down to when? To the December 2015 low. So the spread, in other words, the lessening performance of the miners versus gold, dropped until gold and silver and miners actually made their price low, which was December 2015. But if you look at that spread chart, you'll see that over the last 9 years, since late 2015, the spread has gone sideways. Yes, at a very depressed level, but it hasn't gone down anymore. Now, you say, well, that's a dog. Well, actually not. Right now, the spread is a little bit higher than it was at the close of December 2015. Now, what does that say? It says that miners have been a par performer, sideways performer to gold, meaning they've gone up just as much as gold has during the last 9 years. You tell the average investor that and he'd chuckle, but it's a fact, measurable fact. The miners have matched the gains in gold. The question is now, when do they break out? And you can see I plotted a 3-point downtrend line on that spread. But there's also this basing range of 9 years. I think we're going to break out of this range. And we measure various things to determine when that's occurring, not just this spread chart. But when you break out, look at that line overhead on the spread. The old lows at about 18% over. That's resistance level now. It was support for years and years. If you break out now from where we are, you're likely to find resistance up there. But let me tell you, we're trading just above 5% now. That's a triple and more in the spread relationship. What that says is if that spread breaks out and you even just go to the bottom end of the prior multi-decade range, that means gold miners will have tripled the performance of gold in getting there. So at that point in time, if we see that kind of breakout, I'm of the view that in this phase of the gold bull market, the miners will wake up and no longer just par perform to gold, but vastly outperform it.
Gold and silver often face initial sell-offs during market turmoil, but both tend to recover as investors seek stability in uncertain times. Despite their price volatility, especially during bear markets, they typically rebound, solidifying their roles as safe haven assets. Silver, being more volatile than gold, can experience sharper price movements but follows a similar recovery pattern as demand for precious metals increases. What are your thoughts on the future of gold and silver? Let us know in the comments below. If you found this video helpful, don't forget to like, share, and subscribe for more updates. Thank you for watching.